All right, so let's look at this class exercise. So basically, that's a capital budgeting plan for one company. And I'm going to do it in Excel. And right here, that's the information. So this company is considering a project that will require the purchase of equipment at $1.5 million. So that's basically the startup cost. So the beginning value of equipment is $1.5 million. So I think this is 1.5 million. So make it dollar figure. Actually, I put one additional zero here. And then it also says the ending value of the machine is 150,000. Okay, so dollar. And the lifetime is 5 years. Okay. And based on this information, you can figure out the annual depreciation because the depreciation method is a straight line. So you take the formula of the beginning value minus ending value, okay, divided by the number of years. So that's $270,000. All right, and if we keep reading, then we see annual sales is $950,000 per year. Variable cost is 40%. And there's an annual fixed cost of $100,000. And also we have a salvage value. You see from this line, it tells you that this machine will be sold at 20% of its original cost. So the salvage value here is 20% of the cost of $1.5 million. So it's 20%. Okay, so that's $300,000. Based on this, you can see that salvage value is above the ending book value. So the company is actually making a capital gain. And the capital gain is 300,000 minus this ending book value of 150. So that's $150,000 capital gain. And of course, the company will pay tax on capital gain. And the tax rate is 40%. Times 150,000, so that's $60,000 tax. All right, and we can start the capital budgeting table by build up a timeline first. It's from year 0 to year 1, 2, 3, all the way to year 5. Okay, and the operating cash flow is occurring on an annual basis. In order to get the operating cash flow, we need to find the sales and then variable cost, fixed cost, and the depreciation. And then based on that, we will have a taxable income. It's actually earning before instant taxes, but I do not deduct interest, so it just comes directly to taxable income. And then I need to figure out the taxes I pay. Then I will have a net income, and then I need to add back depreciation to get operating cash flow. Operating cash flow. Okay, so our sales start at $95,000, and it keeps constant at $950,000. Then I just drag it all the way. Oops. So let me increase the width of the column a little bit. And it says the variable cost is 40% of the annual sales, so it's 40% of that. All right, the fixed cost is 100,000. Okay. Depreciation is 270,000. I just borrow this number and I need to lock it before I do the dragging. Okay, the taxable income basically is a sales minus variable costs minus fixed costs minus depreciation. Okay, so that's 200,000. And then the taxes we pay here is 40% times the taxable income. That's $80,000. Keep it straight. And the net income here basically is 200 minus 80, so that's 120, and then keep dragging. And operating cash flow basically requires us to add depreciation back to net income to recover the non-cash effect of depreciation. Okay, so when we add these two numbers, so we got a 390,000. All right, so that is our operating cash flow. And now we have figured out the most difficult part, which occurs on an annual basis. All right, so after we got operating cash flow, now let's talk about the others. So we have the initial investment at the time period 0. That is negative. That equals to negative of this $1.5 million. Okay, equal. All right, and also we have the initial terminal cash flow, or you can call it salvage cash flow, and that occurs only at the very end. Okay, and this equals to the salvage value. You receive that from selling the machine, and then you need to pay the taxes on the capital gain. So that's a 240. And the next thing we're gonna figure out is the change of net working capital, in particular the cash effect from a change in net working capital. If you want to know the change of net working capital, the first thing you need to know what is the net working capital at the end of each year. You see, in the context, it says that your net working capital equals to 10% of the sales, and it is required to support the project. For example, if they want to sell the products in the next year, they have to have sufficient inventory at the beginning of the year in order to keep the business running, right? So if the company has a sales, projects to have a sales of $950,000 next year, then they better have 10% worth of the $950,000 of inventory, which is $95,000 worth of inventory at the end of the year 0 or at the beginning of the year 1. Okay, and then they will keep at a $95,000 inventory all the time until the beginning of year 5 or the end of year 4. And then at the end of year 5, they do not need to maintain that inventory. As it says here, will sell, the net working capital will be recouped at the end of the project. So there will be no inventory at all at the end of the projects, or all inventory will be liquidated. And if you explore the cash effect from changing net working capital, right here we know that from 0 to 95,000, the net working capital increase, right? But what happened to your cash? It actually decreased. Okay, it is negative of $95,000. Or you can put this way: your inventory increased from 0 to $95,000. So you need to spend that amount of money to build up inventory. So that's how much you spend. Okay, so that's the cash effect, and this is part of your free cash flow. All right, and then from year 1 to year 2, how much is your change in net working capital? Let me figure out. From $95,000 to $95,000, so my inventory changed by 0. Okay, and my inventory keeps changing at $0 amount until the last year. So what you see here is your inventory dropped from 95,000 to 0, and basically you sell off the entire inventory and get all the cash. So you will receive, okay, this is positive cash inflow, receive $95,000. Okay, so that's a change of a net working capital. And then you need to find out the free cash flow right here. And the free cash flow include 4 components. One component is, one component is operating cash flow. Well, there's none here, but I still add the, click on that cell because I will drag it later. So operating cash flow is one component, and you also have initial investment, and you also have salvage cash flow. Okay, you also have change of net working capital. So that's your free cash flow for year 0. So basically, you spend money to build the equipment, and you spent money to build inventory. So that's it. And then for the next 4 years, you just receive operating cash flow, although your free cash flow is made of 4 components, but it's only operating cash flow contribute to the free cash flow. And then at year 5, okay, so you will receive not only operating cash flow, but also salvage cash flow. This salvage cash flow of $240,000 come from the salvage value of the machine, which is $300,000, and the tax you pay, which is $60,000. Okay, so that's your free cash flow. And if you try to get the NPV of the project, you see you have a 12% rate of return. Okay, so the NPV basically is using 12% required return. That's a discount rate, and then you're gonna select all the cash flows here from 1 to 5, and then outside the NPV parentheses, you add the cash flow 0. Okay, so this is your NPV for the project. It's positive $950, and you should accept this project because the NPV is positive. All right, so basically this is our case. Later on in your group project, in the Excel projects, you have to do a case that is much more complicated than this. This is just a startup for practice.